All right, we're in the game. Here with my boy JC Parets, a.k.a. Juan Carlos, a.k.a. All-Star Charts. What's up, JC?
Man, Saturday Night Live tells us on 3 separate skits that the stock market isn't working. Does that mean it's not working, or does that mean it's working just fine?
Yo, shout out to Pete Davidson, though. He has the same thing I have. We both have Crohn's disease. And I love seeing him. Love seeing him like mentally healthy and a big part of the show now. And Pete's the man. So he played like a Reddit trader that like discovered the stock market last week, and he's got like gold chains that he bought from a gas station. It's just like it could not be better, honestly, right? It's so great.
From Staten Island.
From Staten Island. Oh my God, it's just awesome. All right, this is the Untitled Chart Show. We're going to chop up a couple of charts that JC sent over. He always has the illest charts. Everybody knows this. That's why subs are booming to All-Star Charts. Let's get into what we think are the biggest trends right now, or the most interesting charts to look out for. I'm going to do your first one right now. I love this. This is the Volatility Index. You got Pete Davidson in the frame. What does this mean? Highest VIX ever for an S&P 500 decline of less than 5%. What is going on?
When people are buying insurance faster than ever, does that normally happen right before you're glad you had that insurance? Or does that normally happen when it turns out you didn't need the insurance?
The biggest sales of insurance are after the earthquake.
That's right.
Yeah.
That's right.
Okay. All right.
I grew up in Miami after Hurricane, before Hurricane Andrew, people were like, it's fun. And I remember I was young, but I remember after Hurricane Andrew, it was like insurance. It was crazy. I remember specifically after the disaster, right?
Yeah.
The fact that the volatility index, which is a derivative of the S&P 500, right? It measures, the premiums priced in. For all intents and purposes, for your average market participant, just think of it as insurance. The more people are willing to pay for insurance, that's probably a good way to think about it for your regular investors. The fact that it is the highest it's ever been, the S&P 500, the highest it's ever been with less than a 5% decline in the S&P 500. The S&P's off 3.5%, and the VIX is pushing 40. I mean, people are scared to death. I can't think of anything more bullish.
For those who are just like, they've heard the term VIX, but they're newer to the markets and it's not second nature to them. The VIX is basically a measure of how many people are buying, how many people are putting on options trades that are insurance to protect themselves against the market decline versus not. Like that, is that the simplest way to explain it?
I mean, listen, it's the implied volatility being priced in at the money options. I mean, it's a little bit more complicated than
that. But what does it mean?
99.9% of investors, just think of it like that, right? It's people buying insurance. The more people are willing to pay for those insurance premiums, the more scared they are, right?
Now, VIX spikes don't predict the market. They're concurrent indicators.
Right.
So the wilder the market gets, usually to the downside, the higher the VIX usually goes, which is why what JC is showing us here is so interesting. Goldman Sachs said that they saw hedge funds degrossing, which we'll talk about that in a second, at the highest rate this month since February of 2009. So degrossing is just, in English, like taking down their notional exposure to different trades, getting smaller. Is that right?
Yeah.
They're shrinking positions because you think about a long short hedge fund, they don't want to be the next target of a meme that like wrecks their value at risk or whatever. So they degrossed at a very high rate last month, according to Goldman or whoever's looking at Goldman data.
To me, Josh, this further reiterates that we're near the beginning of a new bull market, not near the end of an old one. People are scared to death. They're buying insurance when they don't need it, in my opinion. I can't think of anything more bullish. Bearish sentiment, Saturday Night Live telling you the stock market doesn't work. I mean, I think all that's great. Okay,
let's roll into the XLF. So this is where you and I will have a slight disagreement, but don't get mad. There's no way for either of us to prove that we're 100% right. You're showing me overhead supply at a specific level in the XLF going back to 2007. And I agree with you that this is meaningful. I just am not sure that I agree with why. So your take would be that overhead supply, you still have bag holders from 13, 14 years ago who have been waiting for the bank stocks to get back to where they originally bought them so they could break even and sell. So I have that somewhat right, like psychologically.
Well, that's the way supply and demand works, but that's not really my point in this chart. Like, that is true, right? There is overhead supply. That's just a fact. It's not a coincidence that every time it gets here, it sells off. Like, that's not like a giant coincidence like these idiot tenured professors will tell you about the efficient market hypothesis. That's not the way markets work. Supply and demand, this is the market recognizing those levels. But forget all that. That's not what we're
I'm like 70% of the way there. So we're on the same page.
I don't care whether you ever get there or not. That's not my problem.
No, wait, hold on. You understand my only difference is time frame. I don't actually think that people from 2007, it's the same people with the same overhead supply ready to sell. But it doesn't matter
what you think. That's just the case, right? Whether you agree with it or not, that's what's happening. But forget all that. Forget. This is another
I'm
video.
more sympathetic to people that are in this in 2018, 19, 20, now getting back to even, and that stock coming up for sale. I'm more sympathetic to that. All right, let's go.
That's not my point in this chart. That's another video. We can debate that all night long if you want. My point is, JB, this is important. This is really important. I got these people telling me that we're in a bubble. We're in a stock market bubble, JC. JC, you're too complacent. Too much complacency. You know, the Redditors are taking over the market. The SNL, the market doesn't work. They're telling me we're in a bubble. Financials haven't even broken out yet. They're telling me we're in a bubble.
Suck.
The most important index maybe on Earth hasn't even broken out yet.
Why is this the most important?
Can we get a breakout?
Why is this the most important index on Earth?
We don't have bull markets without financials. That's just what it is, right? We haven't even broken out yet. Financials have done nothing for 13 and a half years. Zero. Nothing. And these are the most, I mean, I don't care what you say, not you in particular, but what people say, you know, about how, you know, we don't need these banks anymore, blah, blah, blah. Guess what? At the end of the day, it all trickles back down to the banks. You need the banks, and they haven't even broken out yet. So you want to talk about bullish, whether you're going to buy the bank stocks or not, whether you believe in technical analysis or not, none of that's really the point here. The point is, arguably, the most important sector index on Earth hasn't even broken out yet.
Well, some of the components, though, definitely have. Like you were talking about BlackRock. Some of the asset managers and broker dealers have already. They might be a leading indicator for the XLF.
I think they are.
Right. Goldman, Morgan. These stocks look better than Citigroup
and Bank of America. Right.
The problem is Citi and Bank of America are still a lot of market cap for this index.
Yeah.
So
problem for their shareholders anyway.
You might be waiting on this breakout for a while is all I'm saying. But maybe
we waited 13 and a half years and people were telling me we're in a bubble. We haven't even broken out yet.
All right. FDN is the Dow Jones Internet Index. I never looked at this in my life, maybe. Top 5 holdings: Amazon, Facebook, PayPal, Netflix, Google. Okay, so this isn't a sector per se. It's an
industry group.
It's an industry group. Okay. And how long has this been around?
Forever.
How come more people don't talk about this index?
Because people don't talk about a lot of things that are important because they're focused on like the next BlackBerry short squeeze or, you know, what Janet Yellen said or what this Powell guy.
BlackBerry shortcake?
They're just, people who just focus on the wrong things. They'd rather be focused on the gossip of the day versus what's actually important. And what's actually important is that most of these mega cap stocks haven't done anything since the summer. Amazon, Apple, Microsoft, Facebook, Netflix, Google, they haven't done anything since the summer. People are telling me we're in a bubble and that I'm too complacent. Meanwhile, the biggest stocks in the world haven't done a damn thing since the summer, and I think are in the process of breaking out. But this one, the reason I bring this up is from a risk management standpoint.
Okay.
If you are Mr. Gloom and Doom, if you are that person paying astronomical insurance premiums because you think the market's going to crash, if you're one of those people, you want to watch this index because this is incredibly important, you know, based on the components, right? It's some of the parts. So if this is below 200, FDN, the Dow Jones Internet Index ETF, if it's below 200, then you can start to make that argument that the market is probably in trouble. The market is probably going to come under pressure.
What's the significance of 200?
Well, that was former resistance. There's certain mathematics that we can or cannot get into. If you'd like, we can get into it. But just take my word for it. These are important levels that the market respects.
Are these Are these like are these Fibonacci levels? Like, is that okay?
We can say they're Fibonacci levels. We can call them Pingala levels from 200 BC in India if you'd like. But the point is, the market respects these prices. Most investors don't. That's okay. the market does 200, just take my word for it. That's what this is about. If we're below 200, I think the risk in the market is elevated, but we're above 200. So I don't think it is.
So here's a Zen koan for you, or maybe it's a riddle. I don't know. Or maybe those two things mean the same thing. If most people in the market don't respect those levels, then why does the market respect it? Isn't the market most people?
No, because the market is not a self-fulfilling prophecy, contrary to popular belief, because there are so many different time frames. There are so many different objectives. There are so many different strategies that the fools who talk about self-fulfilling prophecies are just proving their ignorance, right? Like last week, for example, you had so many people proving their ignorance because they don't know the way markets work.
This is what they were taught in books.
Too bad.
Well, okay, but hold on. Most people in the world have not worked in finance, have not worked on Wall Street, have not worked at brokerage firms or trading firms. So the only thing they've ever been told is that stocks are priced based on their fundamentals. And they actually hear that from people that are authorities like Warren Buffett. It's hard to really fault them for like running away with that idea and then looking at everything that's happening and saying how wrong it is. It's just what they learned.
But that increases the arbitrage, right? Because those of us who are aware of this common sense,
I agree with you.
We could take advantage of those who are unaware or not interested in being aware, more importantly.
Dude, there's a guy that he's like a very well-known, very respected hedge fund manager. I've been watching this guy go on TV for 12 years and tell you whether or not the market is at fair value. I've never heard a definition of fair value that reflects the reality of where markets have ever been. Like multiples, PE ratio can be anywhere from 10 to 100. So what in that, just in my career and probably in yours.
Some of the best stocks that we've seen have no PE ratio because they don't have an E.
They're not right.
So
what's
and if you know anything about
fair
math,
value?
There's no ratio if the denominator is a zero.
It's infinity. That's actually a great multiple to buy stocks at over the last 5 years. Okay, so I texted you or I emailed you last week. I said silver. So what I say, silver, bro. This is it, bro. So I'm on the bandwagon just for fun. Like I'm not seriously doing this. I'm doing this a little bit, but I'm hearing about what the chatter on the message boards is, and I'm saying, all right, I'll play. So this is not serious, but I did buy some silver SLV.
Why is it not serious?
Not serious, like I'm not betting my life on meme stocks. I'm just making the point that
you're not going to bet your life on any stock.
Fair. So I'm in Pan American Silver, which I never heard of until Thursday. PAAS. Really? Yeah, or maybe I did, but I forgot about it. I think it's the 9th best publicly traded silver miner, and I bought some SLV. Why wouldn't this go back to the 2011 highs? Which obviously was like a screaming top for commodities. It went parabolic, but why wouldn't it do that again?
Well, just to circle back to our previous conversation, notice how in 2011 it peaked at the same place it peaked at 30 years prior, right? So you would argue that was just a coincidence, right? Because
no, I wouldn't. I wouldn't. And it peaked with. I think the futures market is in commodities is very aware of tops and bottoms because the futures market is not under any illusion that they're buying companies with fundamentals. The futures market understands that they're buying what the next person might buy and selling what
I would argue that's the same thing in the stock market.
Fair.
And the bond market and the currencies.
So silver peaked at the same level it peaked when there was an attempted corner of the silver market in the early 80s.
Right.
And it peaked the same time as gold. And now it's been a decade. And now silver looks like it's ready to rip.
Well, as Luis Yamada, to quote the great Luis Yamada, the bigger the drop, the longer the need for repair, right? The longer the time. And silver lost 80-something%, 84%, I think, something like that, off of those highs. So it takes a long time to repair all of that damage. You have that bottoming process. Again, it's a process. We got back to that former support from 2011, 2012 that we broke. So that former support turned into resistance. Classic technical analysis, and now we're breaking out, right? It took, 7 months, 6 months to absorb that supply, and now we can move on. I think we get to 36, and then I think we get towards 50, yeah. I think
this is going higher. I might add more if it sells off. The fundamental guys like the story, too, because silver, a lot of silver demand, the demand that doesn't go to jewelry or to hoarding, goes to industries that are the future industries of the country, electric vehicles and solar, to name two very big categories that use a lot of silver. So even if that's not true, like in terms of like it's not really moving the needle for more demand, that doesn't matter. What matters is that people believe that it's true, and you can see that in price.
But I don't
So everything
think
comes
that people
back to
believe
price.
it's true. But I don't think, because silver doesn't look like industrial metals. Like look at aluminum, copper, zinc, nickel, tin, lead. Look at those charts and then look at silver and gold. And silver and gold look like one thing and the industrial metals look like another. So I don't think that people believe. I mean, I know there's stories out there, there's stories about anything, but I don't think people are actually pricing in this being an industrial metal.
I agree.
I think the behavior reiterates that it's a precious metal.
I agree.
Hoarders,
I agree
I like that. Hoarders and jewelry.
Well, those are the three sources, right? So I agree with what you're saying, but I'm talking about from a meme perspective, and this obviously is now something that we have to consider.
Touche.
They just started chattering about last week. JP Morgan actually had a settlement. I forget, with either the Justice Department or the somebody, the commodities enforcement, but for allegedly manipulating the price of silver. Now they probably just wrote the check to get left alone. But this is now bubbling up in the memes, is that the banks hate silver, which is obviously not true. No shit. And actually, Citadel is the 5th largest holder of SLV.
And Morgan Stanley and JP Morgan, like they're all
So feel free to run this thing up to the fucking stratosphere. That's fine. You're not getting revenge on hedge funds, Chad. It's not really what's going on. But fine. I think this is going to be a lot of fun. I'm watching all these junior shitty Canadian silver miners. I'm ready to rock, bro. By the way, this morning, little fired up, sponsored by Bagel Boss Coffee. So they're not actually a sponsor. They're providing all the heat.
They will be, though. They're going to be a sponsor.
They will. They will. We are the Bagel Boss's preferred technical analysis show, by the way. So
how can it not be?
So speaking of memes, short interest, just buy them all.
Yeah. Basically
the worst companies in America,
throw darts.
Basically. But this is a list of the shittiest pieces of shit in the stock market. That's why they're the most heavily shorted. Some of these things are 50, 70% shorted.
Well,
and they're crushing.
Not all of them are pieces of shit. In fact, some of them are actually pushing up against all-time highs, which is actually really interesting, because if you have such tremendous short interest and you're pushing up against new highs, that's an interesting catalyst. So this is a list. We sorted it by short ratio and short interest. So how many days to cover, the total of the float, all of those things. And all this is like a lot of our other universes. Just because a stock is in our young aristocrats doesn't mean we want to buy it. Just because it's in the under the hood report doesn't mean it's just calling our attention to these names. For 80% of them we don't want to buy, and maybe 20% of them might look interesting, and then 4 or 5 of them will be like, okay, these are the ones, right?
What are the best charts on? What are the best charts on here right now?
Well, so if you move on to the next one, I brought this in over the weekend. It's a little late as silver's gapping up, right? Yeah. So what can you do? I mean, this thing's up like 40% pre-market.
Is it really?
Yeah. Maybe more actually. But the point is, this is First Majestic, speaking of Canada, pushing up against those highs. If we're above the 2011 highs, I think you got to own it. It goes into the 50s. Gives you good exposure to the silver market, precious metals, the meme squeeze, all those things you're looking for. It's on the list. $4 billion stock, which is tiny. A quarter of the float is short. There's your catalyst, pushing up against new highs. JB's bullish silver. How can we not?
Yeah, man. Well, so I never heard of this one either. The one that you and I were talking about the other day.
Are there any gold and silver stocks that you've heard of?
Yeah, no. Remember Silver Wheaton? It changed its name, but we used to trade SLW. Yeah. WPM is the new ticker. It's called Wheaton Precious Metals now. So I even remember the story of that, because we used to show it to clients. The story of Silver Wheaton was that like they just would go to a gold mine and sign a deal with them where it's like, all right, you guys are mining silver, because gold and silver are always found together. We'll just take all your silver and sell it for you so you could just focus on the gold. And it was like a great business model because they had no asset. Like they didn't have to own the mine. So I remember pitching that stock and it worked. It was It's a
Keep in
massive
mind
winner.
that this is the price action in Canada. So if you're looking at the U.S. ADRs, just make sure you're adjusting for that. But we want to be long above those 2011 highs.
All right, so let's finish with oil, or crude oil went negative, and then commodities went bananas after, and EM too. So explain to us what's happening in this chart and why it's significant.
So I am, relatively confident as one can be in the stock market. But I have some conviction that the commodity super cycle got started last spring, and crude oil trading in the negatives sounds to me like probably a pretty good catalyst to get that going, like that final puke in commodities after such a long bear market. I mean, as a financial advisor, this is a great question for you. As a financial advisor, commodities, any exposure to that space whatsoever for so long has been a bad decision for investors. How do you think about sort of repositioning, reallocating, rethinking that thought process? I'd love to hear your thoughts on this.
So financial advisors and asset allocators for decades, the exposure they had to commodities was in the form of the equities in that sector, or the country weights where those markets were dominated by miners or oil companies. So it used to be like a shorthand, like I'm long Brazil. Okay, you're basically long oil, or Mexico, or I'm long like the UK. The UK was dominated by gigantic mining companies. Australia. Like if you had a weighting to Canada or Australia, that was basically your commodity exposure. And it was useful. It worked because you had oil companies, you had gold miners, you had like fertilizer companies, you had all that shit. Something happened toward the end of the 2000s because of the dot-com bust. The S&P basically had a lost decade, but inflation was real. And as a result, commodities had done really well. So then around 2010, 2011, every major asset management firm started packaging futures, literally commodity futures, into products to sell into wealth management. And you're shaking your head because you know how this ends. They end up actually being a net loser over the next 10 years. Of course they do.
Of course.
So a lot of people put on long-only exposure to futures. They got butchered on the roll every time, like in the ETNs, the exchange traded notes. Every time the commodity ETN had to go from the March contract to the April contract, the guys in Chicago were fucking knives out and they just carved it up. And so it was a loser. It was a bad trade, and that fell out of favor. You don't really see in the 2010s advisors allocating to commodities, and now commodities are starting to work again. So what'll be funny to see is like what people do in response to that. But they might be too busy trying to figure out Bitcoin to remember soybeans. So maybe it won't matter that much.
Energy, agriculture, base metals, commodities in general outperforming stocks. I think this is the beginning. I think what started last year is the beginning of a commodity super cycle.
You like this to continue.
I think we're just getting started, and I think it's bullish for stocks.
But JC, the implications of this, if you're right, are tremendous for asset allocation, because most people right now, as a result of the recency bias, they're overweight the blue line, substantially underweight the red line, and have almost no exposure to the black line. So I think that's going to be really interesting. We're gonna keep following that all year.
Forever.
Forever. All right. So where do we want to send people? We want people to go to allstarcharts.com, subscribe to JC's stuff. He's got a killer blog, and he's got all different types of products now. What's something that people have been interested in lately that you guys are doing?
Yeah, I mean, obviously everyone's looking for the next squeeze. So we came out with a report, just like a lot of other people, of our candidates for the best squeeze. So if you're interested in our favorite ideas for a potential squeeze, high short interest, and good stocks making new highs, more importantly, email candles@allstarcharts.com. Make sure to use the password freshly squeezed.
All right, Duncan's going to put that in the show notes so everybody will know how to get that. All right, you're the man. We'll talk to you later.